We just finished going through Teradyne's 2026 Q2 earnings call materials, and now we want to share our takeaways with everyone. The deck opens with the exact question you're already asking, so let me put it on the table right away. Is this structural normalization, or is it just a cyclical air pocket? Because this company printed record revenue and record earnings, and then guided the next quarter lower on purpose. Let me walk you through it the slow way, one piece at a time, the way I'd want somebody to explain it to me. Start with what actually landed, because the numbers here are not small. The company reported revenue above $1.3 billion, up more than 100% year over year, and EPS of $2.47, up more than 300%. Across the first half, that's $2.6 billion in revenue and $5.02 of EPS, and I'm telling you, that is a monster 6 months. Now, here's the part that stops you cold. Q3 guidance comes in at $1.2 to $1.3 billion in revenue and $1.85 to $15 of EPS, and management points at mobility weakness and compute timing for the step down. To be fair to the bulls, a company that just doubled its business is allowed to have one uneven quarter, and they told you why. Our read is simpler than that though. When a business steps down at the top, you don't argue about the number, you go find out what's underneath it. That's the whole job for the rest of this deck. So what does this company actually do? In plain language, it's the quality gate that everything electronic has to walk through, and the deck lays it out in 3 stops. The wafer stop semiconductor test is the core revenue engine at over $1 billion, split into $843 million of SoC, $212 million of memory, and $67 million of storage test. The board stop product test is $107 million, carried by the Omnix platform built to catch AI defects early. The rack stop robotics is $100 million, driven by electronic and semiconductor manufacturing expansion. And the company flags 3 catalysts running underneath all of it: dual source validation, silicon photonics integration, and the Omnix board test platform. Think about that shape for a second. Wafer, board, rack. The same company collects a toll at every gate, and by industry logic, that's exactly the structure you want when the whole chain is expanding at once. Now let's talk about the quality of this quarter, not just the size of it. Operating margin came in at 33.7% on $448 million of non-GAAP operating profit, and gross margin was 59.8%, up to 50 basis points year over year. It was down 110 basis points sequentially, and the company is upfront that Q1 had one-offs in, which I appreciate. Here's the number I'd put a circle around. First half free cash flow was $579 million, up 150%, with $378 million of that generated in Q2 alone. And cash and investments jumped over 30% sequentially to $517 million. Revenue nearly doubling while cash flow rips like that is rare, because growth usually eats your cash before you ever see it. The company also says operating expenses are rising on purpose to lock in 2027 shares, and calls it active investment rather than passive bloat. Our take, and I'm maybe 80% on this, is that the cash flow backs that claim up. They're paying for the expansion out of pocket, not out of the balance sheet. Here's the single loudest signal in the entire deck. Memory book to bill came in above 2.0, which means for every $100 they shipped, more than $200 of new orders walked in the door. And the company breaks it into 3 lines, all pointing the same direction. HBM is booming, with long-term 2026 expansion plans already finalized, so that's not a hope, that's a plan on paper. DDR is the surprise driven by CPU-oriented applications and an agentic AI recovery that nobody had penciled in this hard. NAND is the inflection, with tangible pull-ins for new capacity after months of silence, and silence breaking is usually where the cycle actually turns. The company projects the memory test market expands more than 40% next year, and says clients are modeling 2027 facility deployments today, which negates the risk of a lumpy demand profile. That last part matters more than the 40%, because it's the difference between a restock and a build out. Now the thing that's actually dragging the guidance, and it's not demand. Compute revenue was up roughly 600% year over year in the first half. The company shipped its first commercial GPU orders, and it completed successful correlation with a second hyperscale AI client. So why does the second half sag? Because customers build capacity in the first half and consume it in the second. And the deck calls that a distinct semi-annual rhythm. It's like loading up one enormous grocery run. The store has a monster week, then 2 very quiet ones, and nobody's eating less. The next deployment peak is flagged for the first half of 2027, and the company warns straight out that extrapolating single-quarter data will produce severe miscalculations of the structural trend. The deck also notes auto and industrial are showing surprising secondary strength, specifically from power management demand for AI data centers. Our read is that the air pocket is real and it's timing, not deterioration. But timing calls have a way of slipping a quarter, so hold that loosely. This is the structural argument the whole thesis rests on, so pay attention here. Test equipment as a share of semiconductor capital spending went from about 4% in 2023 to 7% in 2025 to 8% in the first 5 months of 2026. On the other side, wafer fab equipment is projected to approach $250 billion, driving annual wafer volume growth of only 5 to 10%. Wafers grow single digits, test grows way faster, and the gap is the whole story. The mechanism the company gives is clean, more chiplets per package, plus a constant defect rate equals an exponentially higher cost of failure, which forces exponentially higher mandatory test intensity. The deck then puts AT market potential north of $200 billion. Now the bears would push back, and honestly they'd have a point. A ratio that doubles in 3 years is exactly the kind of thing that mean reverts on you. So call me 70% on the structural break being real, and the company itself is about to hand the bears their ammunition on the very next point. Here's management doing something you almost never see, which is arguing against their own best number. They actively warned against extrapolating that current 8% capital spending share. The reason is mechanical, and the timeline on the slide spells it out. Wafer fab equipment gets purchased and installed in month 1. It finally starts producing functional wafers around month 9, and test equipment shows up in month 10 to test those specific wafers. So test deployment lags fab installation by roughly 3 quarters, and the company says that ratio will likely normalize to 6% or 7% next year. They add that 2027 market scale will still expand, but year-over-year growth rates may face difficult mathematical comps. Read that last sentence twice because it's the tell. Bigger market, harder growth rate, those two things can absolutely be true at the same time, and most people only price one of them. Our take is that this single slide is worth more than the record EPS, because it tells you what the 2027 argument will actually be about. Now watch the AI capital spending wave move down the chain, because it doesn't stop at the wafer. Storage test came in at $67 million, up 94% year over year and more than 150% sequentially, driven completely by AI storage demand, with hard drive exabytes projected to grow over 20% annually. Product test hit $107 million, up 26% year over year and 33% sequentially, with the Omnix platform scaling and broad growth across mass PCB testing, optical, and defense. Racks and robotics came in at $100 million, up 33% year over year. And here's the line that changes how you value that unit. The company says robotics is no longer a detached hardware business. Electronic manufacturing and semiconductors are now its largest end markets, up 50% sequentially. And US sales share has hit 32% ahead of a new domestic manufacturing center. A reasonable read is that robotics stops being the orphan asset people discount and starts being another way to own the same data center bill. Let's do the math the deck lays out, because the arithmetic is friendlier than the headline. First half delivered $2.6 billion, and the company says that's 50 to 52% of the full year, which puts the year at roughly 5.0 to 5.2 billion, and the second half at roughly 2.4 to 2.6 billion. Yes, aggregate Q3 guidance drops to 1.2 to 1.3 billion. But management notes the second half baseline is actually better than their previous internal models, and I think that's a fair point that deserves to be heard. The deck is blunt about what's happening. The weight of mobility weakness and compute timing simply obscures broad-based growth in the other 5 segments. Memory, auto and industrial, storage, product test, and robotics are all on the growing side of that scale. So the honest framing is that 2 heavy things are sitting on one end of a seesaw that's otherwise rising. Our take is that the guide looks worse than the business, and I'd rather own a business getting broader than one getting narrower. This is my favorite slide in the deck, and it's the one nobody would have made them right. Reality check 1, the CapEx normalization. Test as a percentage of wafer fab equipment likely pulls back from 8% to 6 or 7% next year on installation lags. Reality check 2, the market share dilution. The segments growing most explosively are exactly where this company has the lowest historical share. So segment wins take time to show up in aggregate share. Reality check 3, the margin paradox. Memory carries the strongest demand signal with book-to-bill above 2, but memory testing carries lower structural margins, so the fastest growth directly dilutes overall gross margin. Sit with that third one, because it's the real tension in this story. The thing working best is the thing that hurts the printed margin. The deck's own conclusion is that in a record-breaking quarter, management actively shut down overly optimistic extrapolations, and that transparency fortifies the credibility of their 2027 structural targets. By industry logic, I'd agree. A company that volunteers the bad news buys credibility on the good news. So how does share actually get won here, and how would you ever verify it? The company turned that into a 4-stage tracker. Opportunity, which is the bidding phase, then feasibility, then correlation against the incumbent, then production ramp. Cycle time is 9 to 12 months from start to ramp, and fast followers cap out at roughly 30% market share. Here's where the 3 named accounts sit today. Client A is a mature dual source, Client B has correlation complete, and Client C is at feasibility. The context that gives is that a major hyperscaler is diversifying its supply chain for risk mitigation, and that share shifts are won, in their words, slot by slot. Nobody wakes up with 30%, and I've been burned before assuming a design win equals revenue next quarter. What I like is that this framework turns a vague promise into something you can check every single quarter, and that's rarer than it sounds. Connectivity is where I think the strategy is genuinely smart because they refuse to pick a winner. Copper and backplane is covered by the MLTP joint venture, pluggables and MPO and XPO are covered by the Photon 100 platform, and packaged optics is covered by the Quantify Photonics acquisition. 3 different physical futures, 3 different toll booths, all of them theirs. On sizing, the company is unusually honest. The 2028 packaged optics market is described as highly unstable, modeled anywhere from $300 million to $700 million depending on scale. Out success, with 2027 low-end projections around $200 million. A range that wide is normally a red flag, but here it's just somebody admitting the standard isn't settled yet. And the anchor underneath it all is this. Testing the core switch silicon guarantees a baseline revenue floor, regardless of which physical layer ultimately wins the market. That's the part I'd underline, because it means the technology fight can go any direction, and the revenue still shows up. Now the bear case that would break the whole test intensity story if it were true. The argument goes like this. If the first test insertion already yields no good die, why can't the second insertion just be skipped? Skip it, and all that extra test volume disappears. The CEO's answer on the slide is absolutely not. And the reason is physical, not commercial. Validation is physically impossible until the electronic IC is bonded to the photonic IC and the polymer lens is applied for the fiber array connection. The physical assembly step itself creates entirely new potential defects, so test intensity there is described as mandatory, irreducible, and non-negotiable. I want to be careful here. That's the company's position on their own market, and of course it's convenient for them, but the mechanism is checkable physics rather than a forecast, and that's a much harder thing to hand wave away, so I lean toward believing it. Let's tie the whole argument into one knot. The old logic, which the deck calls the linear trap, said wafer fab equipment growth equals wafer volume growth equals test volume growth, with test capped at roughly 4% of capital spending. Test was just a derivative of fab output, and it never got its own engine. The new logic multiplies wafer volume growth by an advanced packaging defect multiplier, and that product is exponential test volume. The deck's own diagnostic matrix is refreshingly balanced, so let's take all 3 rows. The catalyst is that AT is running faster than wafer fab equipment. The break is that short-term lag will pull ratios back next year. And the synthesis is that the baseline is structurally higher. And here's the instruction they give you. Do not model a perpetual upward trend line. Model a permanent upward shift into a higher structural range of 7 to 9% of capital spending with a floor nearly double the 2023 lows. That's a very different investment case from a straight line up, and honestly, it's the more durable one. Last thing from the deck, and it's a scorecard which I always like. On structure, watch whether test as a percent of capital spending holds above 6% through the 2027 normalization, whether memory book to bill stays above 2, and whether the explicitly promised first half 2027 compute surge actually shows up. On market share, track the 3 hyperscalers migrating toward that 30% ceiling and watch for gradual slot by slot, so see share creep in 2027. On profitability, watch whether full-year margins hold the roughly 59% line despite 400 basis points of normal quarterly swing, and quantify how much the massive memory growth actually drags margin. And number 8, the company flags the Q4 target financial model update as the single largest impending catalyst for the stock. Alright, last thing, radar always leaves you a light. I'm calling this one yellow. The structural case is the real deal, and the physics behind it holds up better than most growth stories I read, so I'm about 70% on the multiplier being permanent. What keeps me on the fence is that management themselves told you the ratio pulls back to 6 or 7% next year, and that the fastest growing business dilutes the margin all the way through 2027. Growth that shrinks your margin is still growth, but it's the kind you pay less for. If they hold that roughly 59% full year margin line and memory book, to bill stays above 2 into next year, I flip to green, and I'm telling you that up front. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.